Okay, now we're going to talk about discounted cash flow approaches. I will finish the class with an example where we're going to solve, we will try to find the value of a project using all those 3-4 approaches. So what we are interested in is, we're interested in finding the cash flows and then using the right discount rate to discount those cash flows. Then we're going to decide whether we're going to find the value of anything, and if it's a project decision, we're going to decide whether we should take that project or not. So when I talk about cash flows, you probably remember we calculate the free cash flows for companies, and this is money available to all the investors, debt holders, and shareholders together. And here we have the after-tax EBIT, let's say. You add the depreciation, you deduct any changes in net working capital, and you deduct capital expenditures. So this is how you calculate the cash flow part. This is also called unlevered cash flow. This will be important because different methods will use different cash flows, unlevered or levered. It's going to change. Computing the discount rate is actually difficult. What you are trying to do is you're actually putting some hurdle rate, let's say, on a project. So an equally risky project gives me 10%, so this project should also give me at least 10%. And in real life, you're going to see this is really important for financial managers because having a +1, -1 discount rate will change all of your analysis. And I asked a couple of friends how they calculate the discount rate. When I was in the US, I was talking to a guy from 3M, and he said, we just use 10%, which is the industry average. So maybe they're not doing very highly skilled, highly qualified, let's say, analysis, but it's an important decision, actually. And if you remember, we have different discount rate. We have unlevered cost of equity, which is RA, or RU, depending on the notation you want to use. So it's basically the cost of capital of a company if the company didn't have any leverage. And it depends on the asset risk. It has nothing to do with the capital structure. And levered cost of equity is, as its name is self-explanatory. If a company has some leverage, then you're going to calculate the cost of equity based on this capital structure. It depends on asset risk. It depends on financial risk. And I'm hoping that you're comfortable with these because you did the homeworks and it wasn't bad. So hopefully you're fine with that part. Okay, how are we gonna calculate discount rates? The easiest thing to use is the CAPM. So for CAPM, you need a risk-free rate, which is treasury bill rate, and you need a risk premium. Market risk premium is around 5-6% in the US economy. Beta is important. This beta is the equity beta. So you multiply equity beta with the market risk premium, add the risk-free rate, it's going to give you the cost of equity. Do you remember what beta is? What it measures? What risk? Compared to the market risk. Beta is the market risk. We asked this question to our master PhD applicants in the interviews. Okay, what is beta? It measures the market risk, how your stock return will move compared to the market. Okay, okay. And important thing to note, and we talk about this for a week. Beta depends on firm's leverage. So if leverage changes, debt to equity ratio changes, it's going to affect cost of equity, and this is because equity beta will be affected. And equity beta will increase when debt to equity increases. And I think it was in your homework as well. Okay, now let's go into the approaches. I'm going to talk about 4 approaches. The first one is adjusted present value approach. So this is using something you're familiar with, and it is adding something you're also familiar with. So for adjusted present value, you calculate net present value, which you already know. Right? You know NPV. So what is NPV? Net present value, which is, how do you calculate it? present value of cash inflows minus present value of cash outflows, net present value, okay? And the second part is NPVF. I don't care how you denote it, but basically this is present value of the financing side effects. And you know there are side effects of financing. You already know tax substitute debt. If you use debt, you have tax benefits. You know that if you use equity, there's cost of issuing equity. So these financing decisions will affect your analysis. And there is the cost of financial distress. If you have too much debt, you're going to have lots of financial distress probability and related direct or indirect cost related to that. What kind of costs do we have in the financial distress? Do you remember those? Or in bankruptcy? Let's see whether you remember. If a company is very close to bankruptcy, what kind of costs we can see? What is a direct cost, for instance? Legal and administrative expenses is direct cost. How about indirect costs?
Lost sales.
Lost sales.
Losing customers.
Losing customers, losing suppliers. You have agency conflicts. It might, they might be very costly to the firm. So all these are costs of financial distress. Okay. One thing about the tax substitute debts, hope you remember, it was this one. Present value of interest tax shield. Do you remember when you use debt, you're going to have tax benefits? And this tax benefits will be perpetual, in a perpetual form. So you're going to have some debt. You'll have the cost of debt, which is the interest rate on a bank loan, for instance. And you're going to have the tax benefits. Since it's like every period you're going to have this benefit. And since it's like a perpetuity, you divide it by the cost of debt. So basically, present value of interest tax shield is debt times tax. And for some reason, you had difficulty in that question in the homework, which was probably the easiest question, question 4. I don't know, just read the answer, and if you have problems, see me. Okay. Okay, so what you do is you calculate the NPV of the project when you have all equity. Then you introduce leverage to the picture. So you have, you're going to calculate net present value of the tax shield. And if you have other side effects, you're going to calculate the present value of these added to your calculation. Okay, let's immediately move to an example to wake you up. Okay, consider a project of the Pearson Company. The timing and size of the incremental after-tax cash flows for an all equity firm are this. So you have the initial investment of $1,000, then $125, $250, $375, $500. So what is the first step? The first step is to calculate the net present value. Suppose that cost of equity is 10%. This is unlevered cost of equity. For NPV, it's fine because this is unlevered cash flow. There's no financing effect on this. So what do? Yeah, you calculate the NPV. Minus 1,000 is the initial investment. Then you discount all the future cash inflows. So net NPV is minus $56, let's say. $56 million, whatever. Would you take this project? No, it's a negative NPV project. Are we done? No, we are trying to figure out adjusted present value. We're going to consider the financing effects. So now suppose that firm finances this project with $600 debt and cost of debt is 8%. So now I'm introducing that to the picture. So tax rate is 40%. So the present value of the tax the tax benefit every period will be equal to $19. How did we calculate it? 600 is the debt, 8% is the cost of debt. So this is how much interest you're going to pay. But you're calculating the tax benefit, so you multiply it with the tax, 1920. Okay, so you are going to have an interest tax shield worth 19 million every year. So now, what am I going to do? I'm interested in finding the NPV of the debt tax shield. I'm going to add it to my NPV, original NPV. So my original NPV was $56. And every year, because of the tax shield, I am kind of making, let's say, $19 million for 4 periods. So I'm discounting these 19 millions with cost of debt, not the discount rate, but the cost of debt, 8%. which will give me the NPV of the debt tax shield. So adjusted present value of this project became $7 million now. As you can see, because of the financing, if you use some debt to take on this project, this is actually a good project. Without any debt, it was a bad project. Okay, so the effect of capital structure, again, it's very important. Okay. Any questions on this? So you use unlevered cash flows, you discount those cash flows, you find the NPV, then you look at any present value of the financing effect. Of course, the most common one I can ask you, or you should keep in mind, is the interest tax shield. This is the most straightforward one. You already know it from capital structure classes. If you have a cost of bankruptcy, cost of equity, issuing equity, you have to add it to your calculation, of course. But we don't have it here, so that was easy. The second approach is flow of the equity approach. So this time, we're going to be interested in what is equity holders are getting, actually. So what am I going to do? I'm going to use cost of equity to discount the cash flows, and I'm actually going to use the cash flow of the equity. So instead of using all the cash flows related to the project, I will just focus on cash flow to shareholders. And I will discount those with cost of equity. So I'm doing something very consistent, actually. Look at cash flow to equity holders, discount them by cost of equity. Okay? Okay. So let's look at this example. The same example, we are continuing with the same example. Since the firm is using $600 of debt, initial investment, the cost of investment was $1,000. It means equity holders will have to provide $400, right? We need $1,000 for the project. $600 will come from debt. $400 will come from equity holders. So at time 0, equity holders will have to give $400 instead of $1,000 that we used before. Now what am I going to do? Since equity holders will have to pay interest on debt, I'm going to calculate after-tax cost of interest each year, and I will try to find the levered cash flows, or cash flow of the equity holders. So every year, how much equity holders are paying, there's the interest payment. We are getting rid of the tax benefits. Now I'm interested in how much I need to pay as an equity holder. So equity holders will pay $28.80 each period for debt. So if you remember, this was the original cash flows of the project. Now I will calculate the cash flow to equity holders. So instead of $1,000, equity holders are putting $400 for this project now. And in the first year, we are getting $125, but 28 of it goes to the debt payments. Same with the second period, third period, fourth period. So every period, or third periods, sorry. So every period, I'm gonna deduct the debt payments from the cash flows I'm gonna get. And the last period, of course, I need to pay off my debt. So I'm paying that $600, the original debt value, on top of the interest payment. So as you can see now, cash flows changed. These are original cash flows. These are cash flows to equity holders. Am I done? No. I need to calculate cost of equity. How am I going to calculate cost of equity? I'm going to calculate cost of equity from here. So here there's the long way of doing things. If you want the shortcut, what you can do, well, debt to equity ratio will be equal to, debt is equal to 600, equity is equal to 400. So you can use those ratios and calculate cost of equity. In this example, we are trying to be more precise. Instead of using 600 to 400, I'm actually calculating the true value of the firm because of the financing effect. So what happens here is I'm discounting those cash flows plus the interest tax shield, and I'm calculating the true value of the firm. And from the true value of the firm, 600 is the debt, the remaining is the equity. So 600 over 408 comes from there. If you don't want to deal with it as an approximation, you can use 600 over 400. Okay? This kind of comes from the market valuation of the equity. Okay, When you use it, you calculate the cost of equity to be around 12%, 11%. Then what are you going to do? You're going to discount the cash flow to equity holders with the 11.77% cost of equity. So you're going to have something like this. So flow of the equity approach will give you $28 million MPV as the value of the project. So you're going to say, oh, this is a good project. Any questions about this? Calculate the cash flow to equity holders, calculate cost of equity, discount the cash flow to equity holders with cost of equity. That's it. Okay. Something extra is capital cash flow method. This was proposed by Rubeck in 2000. So we're going to take into account all the cash available to all the investors, including the interest tax shield, everything. And then we're going to discount these using cost of capital cash flow. This is very similar to weighted average cost of capital, but one thing is missing. What is missing? Tax is missing. Normally we should have 1 minus t here. But since this method considers cash flows, considering the interests, it's gonna handle that problem here. Then you don't need to do 1 minus t again. And just give me 10 more minutes. I'm going to solve an example and use all the methods in one example, and you're going to see it's not going to matter actually. All the methods will give you the same answer. So don't worry, it's going to be consistent. Everything will be fine. Just stay with me for a little while. Okay. WACC method is the most commonly used one in the industries everywhere. You remember these: weight of equity, cost of equity, weight of debt, cost of debt, and 1 minus t. To find the value of the project, we're going to discount unlevered cash flows at the weighted average cost of capital. And all the financing effect will be handled actually in those weights and in those tax consideration. Okay, so if going back to our Pearson example, if the target debt to equity ratio is 1.5 for Pearson, debt to equity ratio will be 1.5. So weight of debt is 60%, weight of equity is 40%, which was the original things, right? You put equity holders. Oh, no, it's not. Sorry. Okay, this is something else. This is the target ratio. I'm sorry. Taking it back. Don't worry. So you calculate cost of weighted average cost of capital. 40% is the cost of debt. Oh no, this is weight of equity. This is cost of equity. We calculated in the previous slide. Cost of debt, weight of debt, 1 minus t. Yeah, what I said was true. Okay, so this will give you weighted average cost of capital around 7.58%. Then what are you going to do? You're going to look at the original cash flows, and you're going to discount those original cash flows at the weighted average cost of capital. So MPV in that case will be $6 million. Again, this is a good project. You say you should take the project. So in the discounted cash flow analysis, we look at 4 different methods, plus 1 extra. We have adjusted present value, weighted average cost of capital, and flow to equity. Let's look at their differences. Let's summarize those. And then I'm going to finish the class solving one big example. It's not in your notes, so you will have to write down the answer. OK, so if you want to compare them, comparison in cash flows, APV or WACC, or what was the other one? CCF method. They use all the initial investment. For flow to equity approach, we're just focusing on what equity holders have to pay. And for the cash flows, you're using unlevered cash flows for APV or WACC. For flow to equity approach, you're using levered cash flows. For the discount rates, for APV, you use unlevered cost of capital. For WACC, you use weighted average cost of capital. And for FTE, you use cost of equity. And we only consider the effect of financing, present value of financing in APV. And let's go over those two. Important thing about those is when to use what. So in weighted average cost of capital or flow to equity approach, you should use them when the debt ratio is constant. When debt ratio changes, your cost of equity will change a lot. Do you remember that? If debt to equity ratio changes, beta changes, cost of equity will change. So when debt ratio is constant, you don't have that problem. You can use WACC or FTE. And as I said before, WACC is the most commonly used one. And you use FTE if, or also WACC actually, if a company has lots of debt. In APV, we consider present value of financing effects. So it's going to affect the calculations a lot. For adjusted present value, you use it when the level of debt is known. When you calculate the present value of interest tax shield, you assume that you know that, and it's fixed over time. So APV is used a lot when you're valuing leverage buyout, for instance. If you have high leverage, it's safe to use APV. And if you don't know about capital structure or tax structure that much, again, APV is safer because with FTE or WACC, capital structure decision or tax changes will affect your cost of equities or weighted average cost of capital a lot. So this is the general idea of which one to use when. But now I want to go over this example, and I think you're gonna see things better. Please read the question. So a new company is considering a project that will generate cash flows of $3 million a year for perpetuity. So let's write what we know here. Okay, cash flow $3 million a year. Okay. The initial investment is $10 million. And you can finance this project all equity, or you can finance it with $5 million equity and $5 million debt. And cost of that is 10%. We assume that the discount rate on all equity finance project in this class is 20%. So basically, cost of equity is 20%, sorry. And the tax rate is 40%. So the question asks, should the project be accepted or not? So let's start with the basic case. It's all financed entirely by equity holders. So okay, there is no effect of leverage, let's say. Okay. So how am I going to calculate the NPV of the project? This is like a perpetuity. But what I need to do is I'm going to calculate NPV. But for that, I need the cash flows. But for that, I need after-tax cash flows. Okay? And then I'm going to divide it by the discount rate. This is a perpetuity. I'm using perpetuity formula. And then I'm going to deduct the initial investment. So it's going to give me the NPV. So this part is easy. I know cash flows are equal to $3 million a year. But this is not after-tax cash flow. So for after-tax, I need to get rid of the tax part. So this is 1 minus the tax rate over the discount rate. Since it is all equity, I can use this one very comfortably. So the discount rate will be equal to 20%. And the initial investment is $10 million. So NPV of the project, when it is financed by all equity, will be equal to minus $1 million. So would you take this project? You don't. It's a bad investment. Okay. Now, okay, for that, I'm going to use all those 4 methods. Let's start with the flow to equity approach. Okay, let's write it. So for flow to equity approach, do you remember what we need? We need cash flow to equity holders, and we need cost of equity. Can we use this cost of equity? No, because this cost of equity was given when it was an all equity firm. This is actually RA or RU. Okay? So we will need to calculate the new cost equity. Okay, so let's see what we're going to do. The first step is estimating the cash flows to equity holders. So my EBIT is given. EBIT is $3 million, how much you're going to get. And you're going to have interest payments from here. And how much interest payment you're going to pay? You have $5 million debt with 10% interest. So how much interest? 0.5, right? So this is the interest payment. Okay, so EBT will be 2.5 million. Then you need to pay tax, and the tax rate is 40%. So you pay 40% of 2.5 to the government, which is 1 million. So whatever is remained is cash flow to equity holders, which is going to be equal to 1.5 million. So this was the first step. Am I done? I'm not done. Now I need to calculate cost of equity. How am I going to calculate cost of equity? From this okay, from here. So I know the tax rate. I know the cost of assets, which was 20%, cost of an unlevered firm. I know cost of debt, it is 10%. I know how much debt I have, but I might have a problem with the equity value. Why? Equity holders initially invest how much money? $5 million, right? But market value of equity will change because future cash flows are changing. So in that case, I need to recalculate the equity value. It's not going to be 5 anymore. It's going to be something else. So market value of equity changes. And how am I going to find it? It's actually will be like this. Let me write it here. Market value of equity will be determined by the cash flow to equity holders, which is going to be 1.5 million cash flow. And I'm going to discount it by the cost of equity. But I don't know the cost of equity yet, which will help me here anyway. So what am I going to do? Let's just write down what I know. I don't know cost of equity. This is what I'm trying to calculate. RA is given. It's 20%. Plus debt value is 5 million. It's fixed. I said that market value market value of equity is changing because future cash flows are changing now. And the market value of equity is here. Let me just write that one. Cost of equity. This is going to be the market value of equity. And then 1 minus the tax rates, 20% minus 10%. Cost of equity minus cost of debt. So this is going to give you a return on equity of 25%. As expected, cost of the unlevered firm was 20%. This is higher than 20%. Why? You're taking on more debts, so your investment is getting riskier. It's not surprising. So now I can calculate market value of equity. So market value of equity will be equal to 1.5 million over 25%. It will actually be worth 6 million. So this is the new market value of equity. So your initial investment was $5 million, but now it is valued by the market as 6 million, okay, because of the new structure, debt structure. So what's going to happen to the NPV of the project? How is it going to change? It's going to be plus 1 million. So what happens is if you can look at from the firm side, what's going to happen? Well, you can look at the value of the firm. Value will be equal to debt plus equity. So debt is worth 5 million. Equity is worth 6 million. So it's 11 million now. And the initial investment was 10 million. So you have 1 million NPV for this project. So you actually created value by changing your capital structure. So would you take the project now? Yes, you would. Okay. So this was flow to equity approach. Now go to WACC. Let's go to WACC, weighted average cost of capital. So in the weighted average cost of capital, what I need to do, I don't need to change the cash flows, but I need to change the cost of capital I'm using. Okay. Let's see what we have here. Let's write down WACC formula. So it's going to be cost of debt, 1 minus tax rate, weight of debt, plus cost of equity times weight of equity, right? Okay, what are we going to do here? Cost of debt is given. It's 10%. 1 minus tax, I know. What is weight of debt? We already calculated it. That was valued 5 million. And the total value of the firm is 11 million. From flow to equity approach. We already calculated it. Okay. And then cost of equity. Again, I'm not using 20% because now I have debt. But I'm using that 25% cost of equity, which I already calculated. So it's going to be 25%. Weight of equity will be equal to 6 million over 11 million. So from here, you can find the WACC, which is equal to 16.36%. Okay. Now, what I need to calculate, I already calculated in the first part, but let's write it again. I need unlevered cash flows. Here I have levered cash flows. I cannot use them because I'm using weighted average cost of capital. So let's calculate unlevered cash flows. How am I going to calculate it? I'm going to start with EBIT of 3 million. And from that 3 million, I'm paying tax. This is unlevered cash flow. I don't care about interest payment. So you're paying 1.2 tax. So cash flow is 1.8 million. If you remember, this is actually what we did here. The same thing. After tax cash flow, 3 million times 1 minus tax, 1.8. It's the same thing. Okay, so once you know it, the rest is easy. How do you calculate NPV? It's going to be basically cash flow per year, which is 1.8 million, over weighted average cost of capital. Let's write unlevered cash flow over weighted average cost of capital, perpetuity, minus initial investment. So I have 1.8 million over 16.36% minus initial investment of 10 million. So it's going to be equal to 1 million again. So flow to equity or weighted average cost of capital, same thing. Any questions here? Okay. Then I have capital cash flow approach. If you remember, in the capital cash flow approach, I need to use cost of capital cash flow, which is equal to weight of debt, cost of debt, plus weight of equity, cost of equity. So I'm going to use this. And then I need to calculate cash flows, which is available to both equity holders and debt holders. So this part is easy. I already know all the components. Weight of debt was equal to 5 million over 11 million. Cost of debt was 10%. Weight of equity was 6 million over 11 million. Cost of equity, we already calculated it was 25%. So from here, this will be equal to 18.18%. So this is the discount rate for capital cash flow. Then what do I need to do? I need to calculate the cash flow available to equity holders and debt holders. So again, start with EBIT, 3 million. After that, you pay some interest. And if you remember, it was 0.5 million. 5 million debt with 10% interest. So EBT is 2.5 million. Then you need to pay tax to the government, which will be 1 million. So cash flow to equity holders will be equal to 1.5 million, which we already calculated in flow to equity approach. Are we done? We are not done. I'm interested in finding cash flow to equity holders and debt holders. So what am I going to add to this number? Interest payment. So add the interest payment, which will go to debt holders. So it's going to be equal to 2 million. So this is the cash available to both debt holders and equity holders. Then what am I going to do? I'm going to discount those cash flows at the capital cash flow discount rate. So NPV will be equal to 2 million cash flow to all the capital providers over the discount rate, which is 18.18%, minus the initial investment, $10 million, which will also be equal to 1 million. So NPV with this method will be equal to 1 million as well. We have one more. We have one more. APV, yeah. We're going to do the APV. Where should I write it? Let's go back. Huh? Let's use it. Use this part, huh? Okay. So with the last one is the APV approach. So what do you expect NPV to be? 1 million, probably, yes. So with APV, what do I need to do? I need to do NPV over NPV of financing effects. For this, I'm going to use unlevered cash flows again. Okay? Okay. Let's look at two things here. You can use all equity financing, or you can use debt and equity. And let's look at how APV will change. So if you have all equity, what are you going to do? You're going to calculate the NPV of all equity part. This is going to be the same. This is just a reminder. NPV will be equal to 1.8 million over 20% minus 10 million, which we already did. It was minus $1 million. You don't need to write it down. It was the same, just in above. But I'm interested in how financing will affect my calculations. For this, I need to calculate the NPV of the tax shield. So what is the NPV of tax shield? How do we calculate it? So basically, it was debt times tax rate, if you remember. Debt is equal to 5 million. Tax rate is 40%. So this is going to be 2 million. This is already done as a perpetuity, so I don't need to divide it by discount rate. So originally it was, let me write the original one, sorry. So normally it was this, right? This already handles the problem. So it's going to be debt 5 million times the tax rate. So it was 2 million. So what I'm going to do, I'm going to calculate APV, adding the present value of the tax shield to the NPV if it was all equity financed. So as you can see, NPV is equal to 1. So the takeaway from this is those approaches more or less give you the same results, same conclusion. But you need to, we made very simplifying assumptions. We use a perpetuity. If it was an annuity, things weren't going to change. But we kept everything constant. Debt ratio was constant, capital structure, tax rate, everything is constant. In a world like this, of course, all approaches will give you the same thing. So depending on what you need, you should look at which method is best for your purposes. and then go with it. Okay, so that's all for today. If you don't have any questions. Okay.